Hi everyone, welcome back to the UK crypto tax video series that I'm doing with one of the leading crypto accounting companies around called Miner. And this will be part 4 of that series. So if you haven't watched the first 3 parts, I think it's better to watch these in order if you're interested in finding out more about crypto tax in the UK. Because we've covered the basics, such as when capital gains tax versus income tax might apply, to more complex areas such as airdrops, crypto loans, etc. And I've included links to these above and in the description to this video. But I'm pleased to welcome back to this video Jamie Nuttall, who's the head of crypto tax at Miner. He'll be answering some questions on UK crypto tax for us again. If you are interested in getting specific crypto tax advice based on your personal circumstances from one of the best crypto accounting firms around, then I've included a link in the description of this video to contact Jamie at Miner directly. You just need to make sure you put my name and YouTube channel in the online inquiry form, just so they know where you've come from. And if you're interested in seeing your crypto tax position yourself and using an automated crypto tax platform, then I've included a link to Koinly in the description of this video, where you can sign up for a free account and view your potential capital tax gains, losses, etc., with you only needing to pay once you need Koinly to produce a tax report for you. So please do like this video and subscribe to the channel so I can continue to offer more content for you in future. A quick apology from me that I seem to be losing my voice and I'm not 100%, but hopefully it doesn't affect the video too much. Just a reminder that nothing contained here is financial or tax advice, and let's jump straight in. Hi Jamie, it's great to see you again. Thank you so much for jumping on another video and really helping crypto investors out there in the UK by answering some questions on crypto tax.
Yeah, that's absolutely my pleasure, mate. Genuinely. It's really enjoyed the last one. Thought we'd come back. I know you and I keep in touch with all things crypto and taxation. So yeah, my pleasure. Genuinely enjoying it.
Yeah, no, but the same. I think it says a lot about the fact that we're doing a 4th video here in terms of the depth of it and the understanding of it and the complexity of it. So
Yeah, it's never ending, especially with changes to the guidance and the law going forward. It's going to be adapting all the time. I can't imagine 1 or 2 videos would ever be able to cover the scope of it, let alone the depth of it all. So yeah, no surprise at all. And yeah, just a big shout out and thank you to your viewers who've been commenting and just getting stuck in, because it is an important topic. It's very vast, shall we say, and can be complicated in areas. So yeah, having someone like yourself being able to spread the knowledge is, I think, a great contribution towards the community. So thank you.
yeah, no, thanks. Yeah, just education, isn't it? That's the aim. I mean, our last video was actually about 3 months ago now. And I know since then there's been an update from the HMRC really. They've been sending out chaser letters to certain crypto investors who they believe have made capital gains. Do you want to just touch a little bit on what they are, those chaser letters?
Yeah, definitely. So the initial let's backdate a little bit. Initially, they sent out letters which were nudge letters, and these letters didn't require any reply or any action at all. It's just a case of going, you might have this, please check it. The letters that have been sent out relatively recently are more aggressive. These require an actual reply to say you categorically do or do not have anything to report with HMRC. Now, if you were to categorically say you had nothing to report and it transpired you did, even if it's years down the line, I could see HMRC using this documentation that you have signed and declared against you to really pull you up on it, which I think is somewhat fair, because you shouldn't be saying you categorically do not if you do not know. Now, what this would mean is if you're not sure, you need to figure it out or pay someone to figure it out for you, unfortunately. By not replying, you're risking a lot of issues further on down the line. To be perfectly honest, it's just going to cause more of a headache, because you do need to sort it out eventually. They're not sending it to everyone. So yeah, for any of your listeners, if you have received it, please think seriously about your reply. And if you are not sure, check your posts, be very careful. But yeah, it's a little bit more aggressive, and I can only foresee these types of letters from HMRC getting more and more aggressive as we progress.
Yeah, definitely. And I think linked with that or following on from that, perhaps it might be a good kind of time to explain the difference between tax avoidance and tax evasion, because I think that is important for anyone that doesn't know the difference and is kind of links to what we were talking about.
Yeah, so tax avoidance is legal. Now it still has a bit of a stigma to it for some reason. So for example, I have a business minor and we would put through expenses through the business, quite normal, staff expenses. Now that's avoiding tax. You are reducing your tax liability in a legal manner. Now that can go from something very basic like that all the way through to something more complicated like well, it could be literally anything, to be honest. I won't go into too much detail. But tax evasion, on the other hand, is completely illegal. Okay. So that's where you just don't pay tax, for example. You're evading tax. The way I try and remember and distinguish between the two, tax evasion starts with an E, evil, tax avoidance, A, angel. That's how I've always memorized it since I was studying, many, many years ago. So yeah, one is legal, sometimes frowned upon. The other one is just categorically illegal. So if anyone talks about tax evasion, that's a whole new kettle of fish. But if someone says, oh, tax avoidance, do this, that, and the other, it's not necessarily illegal, shall we say, because some people get it wrong. But yeah, big difference between the two.
Yeah, I just wanted to highlight that because I think that's with these chaser letters, I think that's what they're pushing along, isn't it? They're trying to get to a point where people are essentially evading rather than avoiding.
Yeah, yeah, exactly that. So if you have something to pay and you don't pay, or you say categorically do not have to pay it, you are evading tax because that's illegal. It's just a miscalculation on your behalf. So yeah, it's definitely would fall under tax evasion. And that's probably one of the top reasons why these letters are going out to kind of catch those who are evading tax as opposed to those who are avoiding tax. You can see where their efforts are targeting, which I support, to be honest. I target those evading rather than those avoiding.
Yeah, definitely. And I've been on a few calls with people who really are looking to do this in the right way, in the sense of, yes, I've made gains or I will make gains on my crypto. How can I avoid tax in the best possible way? And they're using services such as you, Joe, Miner, and Nefos to help them with that.
Yeah, and that's exactly it. I mean, you would be daft not to look at reducing your tax bills legally. It's there for a reason. Just because you don't know about it doesn't mean you're not entitled to it. For example, if you were a trader or have something in the miscellaneous income section for your tax return, a lot of people might not realize you can actually claim trading allowance, which is £1,000 tax free. Now, if you let's say you set up a YouTube video and you earn £900 for it through the affiliates program or whatever it is, that can be tax free under self-employment or miscellaneous income with a £1,000 trading allowance, so you don't have to pay a penny in tax.
Yeah, that's really interesting. What are the it's a bit of a depressing start maybe, but what are the possible sanctions? So if you did evade essentially, or you just ignored it further down, if you don't end up paying tax on your crypto gains, what are the possible sanctions in terms of how much crypto could you lose in terms of like a percentage?
So, let's talk worst case scenarios here. Like, there's a spectrum on severity and whether it's accidental on purpose, whether you're hiding it or not. Even if it's accidental, we're looking at fines. We are looking at fines straight away at the very minimum and interest as well. So, what's the worst case? The absolute worst case genuinely is jail time. Like, if it's that severe and horrific, it's jail time. I've never seen it, and I hope I never see it with anyone in my sort of peripheries, but that can happen. What is more likely is in a situation, and we're talking absolute worst situation, whereby you are purposefully hiding and you are also actively, you're purposely not doing it right and you are actively hiding it as well, and it can be proven by HMRC. The maximum penalty for that is up to 100% of your tax liability. So you double your tax bill effectively on top of interest and etc. Now, what could your tax bill be? Oh, it's 20%. Well, if you are in a situation where you are earning in crypto or something like staking mining and you're in a miscellaneous income and income tax regime, the highest rate of tax there is 45%. So just from a very layman's perspective, if you have to pay 45% tax in something and you've got 100% penalty, that's 90% tax plus interest. So it is enough to bankrupt most people, I would say. And that is the worst in terms of them proving that you did this on purpose and you are actively hiding what you are doing. So absolute tax evasion to its core with evidence and the whole lot. And I think that letter, I would say, could be used against you in that if you say, no, I do not, when you did. So be very careful.
Yeah, that's interesting. If we come back to the tax avoidance more than evasion and punishments, etc.,
Yeah.
what are some of the strategies, possibly talking generally, not obviously everybody's financial kind of circumstances are different, and it needs to be on an individual basis.
Yeah.
Obviously, this isn't advice for anybody, but what are like some strategies to reduce capital gains tax? So thinking about maybe borrowing against it, tax loss harvesting, that kind of stuff.
It's a very good question. Right. I'm going to have a shameless plug here. You can edit it out later if you like. I've got a relatively new TikTok channel that goes through all of this. Okay. Crypto Tax JME. It's a nice little few video sets that goes through everything. The top things that I find most people would make use of as a general Web3 crypto investor would be interspouse transfers. So not everyone remembers that you can transfer between spouses tax free and make use of, say, their annual exemption or whatever it might be. Another one would be the trading allowance we just mentioned. So if you've got mining or staking, you could have £1,000 tax free straight from the get go, which is quite useful. The other one is, or the third one, should I say, is the making use of your annual exemption full stop. Now, this historically was 12,300. It went down to 6,000, it's now down to 3,000. If you do not use it, you lose it. You cannot roll it forward. So make use of that. How do you do that? Maybe you purposefully create gains towards the end of the tax year to make the use of that, and then you effectively get taxed less in the future, if you like. There's less of a liability in the future. So that's the top one people often ask. This is a controversial one, this next one, but I strongly believe it, and it sounds stupid, but it's true. Get your taxes right. If you make mistakes, it's going to cost you your time and effort and maybe money for someone to fix it. If you get it right initially, all of that goes and you'll pay the correct tax. Because if you get it wrong, you might pay more, for example. So how do you get it right? Take your time, learn, or hire someone, I don't know, like myself, to do it for you. So just get it right is a strong one, which is a weird one to say because it seems so basic. But I'd say those are the top sort of four ones that I get asked most. The final one, which people don't tend to ask but tend to need the answer to, is use software. Always use software. I don't care how simple it is. It's relatively affordable software. There's plenty out there. And we work with a few quite closely. It will cut the work down immensely, to be perfectly honest. I know, for example, my prices with the firm would easily double or triple if we did not have those software available. So yeah, those are my 5 sort of general tips as a whole. But yeah, hopefully that helps.
Yeah, perfect. That's brilliant. We've talked before about potentially for individuals using that automated tax software or platforms initially to have an understanding of their unrealized and realized gains and losses, potentially going from there. And if it is too complex, we've talked about there being duplicate kind of transactions in there, missing cost bases, all of these issues within that software. And then if you need help, going to somebody who can just do it for you.
Yeah, it's not for everyone. It really does depend on the individual. But I'd always start by having a look yourself and being brave about it. What have you got to lose apart from a few hours of your time? Because you never know, you might just smash it. out the ballpark. And if you really find an affinity to it, send me a message. We're always hiring.
So just going back to crypto tax loss harvesting,
Yeah.
that's when you realize a loss. Is it to save future tax?
Yeah, kind of. So tax loss harvesting, or as some, I think it's a US term, wash trading, is effectively where you crystallize losses for current or future use. The way it works is if you were to buy something for £1,000, it's now worth £100. You can't make use of that loss until you crystallize it. So it's just sat there on your portfolio as a potential loss, if you like. In order to crystallize it, you need to dispose of the asset in most situations. And this includes selling it, swapping it, trading it, whatever it might be. Just getting rid of it. As long as you don't buy it back within 30 days, in most situations, NFTs kind of sit outside that scope, but pin in that for now. As long as you don't buy it back within 30 days, you have crystallized, in this situation, a £900 loss. This loss can then be used currently or carried forward indefinitely. Now, this is a big misconception. You can carry forward your losses forever as long as you claim the losses within 4 years. So tax loss harvesting, you probably look at towards the end of the tax year, February, March time, when you go, right, here's a list of my assets. Here's a list of how much it costs. Here's a list of the market value. Here's the difference. Am I sitting on a gain of, say, £20,000? And do I have losses I haven't crystallized of 10? So I might want to crystallize, say, 8 of those 10 to reduce me below 12,300. And then you go, actually, it's 3,000 annual exemption this year. So I need to find a further 9 grand plus on top of that. And you start tax planning and looking at it all. Even myself, I just forgot that it's gone down from 12,300 and this is my job. So yeah, you need to crystallize it. The other option, which is quite similar to tax loss harvesting, is something called a negligible value claim. Now, we might have spoken about this before, I'm sure we did, but it's effectively where you can't sell it because there's no requirement. So, sorry, no demand. There's no demand for that asset. Maybe there's no liquidity. Maybe the gas fees are too high. If the value is of negligible value, you can make a claim as if you sold it and bought it back, ignoring the bed and breakfasting rules in section 104 and 104.5. So you crystallize that loss in a similar way. So I'd say tax loss harvesting and negligible value claims go hand in hand.
We covered section 104 in a previous, and pooling, we covered that in a previous video. So if anybody wants to kind of understand that, then maybe go back to that because we won't go into that now. If you, in terms of NV or negligible value claims that you've just mentioned, what happens if you've lost your crypto or if you've lost your seed phrases?
That's a difficult one. Now, HMRC, I believe, have said you can't really make NV claims on these. I'm speculating that it's because the scope for fraud can be quite high here. I've lost my wallet, it's been stolen. However, I would say in certain situations, it should be okay as long as you let HMRC know exactly what's going on because it's a grey area, I would say. Now, as of 2 days ago, I believe, from the time of this recording, there's been legislation that's been passed in the UK that crypto is now considered legally personal asset and a personal asset. So what this means is there should technically be more protection around stolen and lost wallets. How this practically works, I'm not sure, but it gives the option. Now, is the knock-on effect that if you follow certain steps and processes, NV claims are more not so much of a grey area. That could be the case. It's just really interesting to talk about because it's completely new that's just come into play. I think it's not anything too big, but there might be a knock-on effect with this type of thing. So yeah, lost and stolen wallets, you might be able to. It really does depend on the situation and whether you've reported it to action fraud, etc., and can really prove it, I guess, rather than just claim it's lost or stolen. But HMRC haven't really making a solid stance on it, shall I say. There's guidance that says you can't, but I'll leave it at that.
Yeah, yeah, you can't say. I think It was the 11th of September. So there's a new, for anybody that hasn't picked this up, I've actually had a few comments already in some of my videos asking about that. So people are definitely on the ball with that. But it was the 11th of September. So a new bill's been introduced into Parliament with the aim of increasing legal protection for crypto holders, crypto investors in the UK, where they're considering, I believe, as personal property now. And perhaps I'll do a video on that specifically. But yeah, that's really good. Thanks, Jeremy. Um,
Just to finish up on that announcement while we're here, it it does seem like it's a lot of nothing at the moment, genuinely. I just hope that there's going to be a ripple effect that other areas will be affected by this in the future. Maybe they're building on it. I believe it's a double-edged sword. I think there's going to be something that happens with the budget that might rely on it being considered personal property. But it's far too soon to see. Either way, it's good to see legislation with the word crypto in it and really taking this Web3 realm seriously. I think that's the important part here, that there's steps are being taken to really make it feel like it matters, because it does matter. Crypto is very important in the UK.
yeah, and I know we're going to have a chat in a future video on the potential outcomes of the budget. Obviously, we don't know, but it'd be good to have a chat there as well about potential things that come from that.
Absolutely. It's a big can of worms, and we'll be we'll be sharing some information from mine. I've already shared some bits and pieces on my Twitter page around it all, but it'd be good to have a proper chat about it because it's very interesting, and there's a few options definitely.
And I know I just asked about lost crypto and NV claims and stuff. What happens if you lost crypto? Because we've had some quite big incidents in the last few years, really. If you think about FTX, Celsius, etc. If you lose your crypto through platforms such as that, what's the ruling there? Are they written off for tax purposes? Can you claim them against gains? And then what happens if, as a creditor, you get that back in the future?
I reckon there's about 5 people in the country at the moment that can fully explain this. Luckily, I think I'm one of them. Um, let's start with FTX and Celsius are two completely different situations, okay? For various reasons. The main one, from my understanding, is with FTX, you have the ability to sell the right to your debt right now, okay? So therefore, you could say that even though your assets are you could consider them of negligible value because your beneficial ownership on the assets is just basically zero, you still have something, a right to that asset that has a market value, because you can sell that for, I don't know, 50p to the pound on a secondary market. Now, I was involved with it, but my understanding is you can sell this to someone else. They then own the right to your debt. And if anything happens, they get all the benefits from it. You get nothing because you've sold that right. Okay. So that's FTX. Celsius, you can't do that as far as I'm aware. So that's why there's a difference. So with FTX, you can't really do much at the moment. There is potential, depending on your situation and exactly what's going on. I'm not a big fan of doing too much at the moment unless we absolutely have to, because there's just so much scope for things to change and for HMRC to turn around and say, actually, that's not quite right. Because with Celsius, it's a different ball game completely. Now, this is very technical, so I'll try and put it down as straightforward as possible, but there's lots of steps. So the first one is acknowledging that your beneficial ownership of the assets would have changed at some point, okay? Now, when would have changed and why is it important? It's important because that's when there's going to be a disposal considered or an acquisition, depending on which way around it is. When did it happen? There's 2 points. So, in fact, there might be three. There's 3 points when it could happen. When you initially deposited your funds into Celsius, you could have lost beneficial ownership at that point. Unlikely, but possible. The next point is when they changed the terms in their contract. If you reviewed it, you could argue that you lost beneficial ownership at that point. And the third point is when they filed for section, was it called section 11 or something, bankruptcy in the US? When they filed for that, I would say that is more than likely the moment where you would have lost beneficial ownership at that point. So one of these 3 points, you could have lost beneficial ownership. So that's point one. Why is that important? That means all your assets that you put into this platform that you had control over, you now no longer have control, and it's a disposal at that point, or one of those points. More likely one of the latter two. Okay, so that means you've created a gain or a loss. And you're like, Jamie, hold on, this is not what I wanted. We'll get there. The next step is to acknowledge that you are exchanging your assets for a right to those assets with equivalent value at the market rate at the point of disposal. Okay. It is this right that is the key here to what we can do, because you can claim a negligible value claim on this right that you have of being zero or whatever it might be, which would then create the loss that you're trying to create. Any gain or loss that you set off initially with step two by that disposal will be set off with this new loss and some. Okay. And then the next step is when you get something in return eventually back, whether it's BTC or ETH or shares in a separate entity. That's the question. That's the difficult bit where people go, well, that's income. Oh no, hold on, it's free. Or should I set it against that negligible value claim? You can set it against that claim at the time if you do it in the future when it's all dealt with. But if you did the claim first, what do you do later on? You pay capital gains tax on those assets. Now, that's very counterintuitive to all things that taxation. Now, the way I think about it is when you make this negligible value claim on the rights, you need to taper that to the amount that you get back. So if you lost 100 grand and eventually you get 20 grand's worth of assets back in shares and Bitcoin and Ethereum, surely it makes sense that you can only claim on £80,000, i.e. the difference between the two, what you lost and what you got back. So that kind of negates itself and works its way out in that way for starters. So it does make sense. So step one, lose beneficial ownership, exchange it for a right, create a gain or a loss. Step two, make a negligible value claim for said rights to create an additional loss. Step three, consider what you have received in lieu of what you've lost as a capital gain. Okay, those are the three steps. And if you follow that, you should appropriately claim the losses for the Celsius situation. I know that's gone on quite a bit, but it's very detailed and technical, and that's just the tip of the iceberg. There's a few bits and pieces we need to deal with there, including the fact that how the reason why you claim a negligible value claim on the right is let's say you lost Bitcoin. How can you possibly say that Bitcoin has no value? You can't. Your beneficial ownership is zero, but Bitcoin still has a value, so you can't claim an NV claim. It doesn't qualify. But if you claim it on the right to have the Bitcoin, that's where it makes sense and technically correct.
That's what I was going to ask in terms of if you got 100% of your crypto back.
Yeah.
You're going from then the NV claim to when you get it back. That's what you said, isn't it?
So yeah, if you had £100,000 in Celsius and you lost it all, long story short, you claim £100,000 as losses. But if you got it all back, you claim £100,000 as a gain, and the two will net against each other. And any variances between the two would also result in a total claim or total value of 100 grand in this instance.
If you had 100,000 of Bitcoin and you get that Bitcoin back, or are you getting the fiat value back?
Right. So this is going to get very complicated. And the way, if you follow this process, that will negate those issues because it takes the market values at the time and it kind of makes it fair. So you have to remember, we do it on fiat value rather than Bitcoin. So one Bitcoin is kind of irrelevant. It's okay, well, how much was that worth at the time of disposal, at the time of writing off the or making the NV claim for the rights to that one Bitcoin, and how much was it worth when you receive it? So it might do really well because of the markets, or you might do really badly. It's irrelevant. It's all about the value.
What I was kind of getting at with my question was, might somebody have a capital gains tax bill if the value of Bitcoin's gone up massively and they've made a gain by getting that back?
Yes.
Oh, okay.
But when you get that back, you crystallize the gain at that point. So you have that Bitcoin that you can dispose of to pay your tax bills. So it's not like you'll be out of pocket. The problem is if you do that and you don't think about your taxes, and then 9 months later you do your taxes and Bitcoin's shot down, and you go, oh, I've got to pay a gain on £200,000 worth of Bitcoin, but now it's only worth 100,000. You know, that 20% tax bill is now 40% effective comparison to what I've got in my bank. And you think, okay, at least I can afford it. But what if the tax rates at the end of October go up to 40% as an example? That's an effective 80% rate at that point, because that's 80% of what you've got left. So yeah, it's absolutely 100% think about your taxes as soon as possible. But if you've got someone like myself or yourself in your corner, we're just a message away, a comment away. Maybe you've got our direct lines if you're our clients to get this sorted as soon as possible and ask questions.
Yeah, it just doesn't seem, it's that word, isn't it? Fair. But if you've essentially lost it through no fault of your own, if you had like one Bitcoin and you're getting one Bitcoin back, but the value of it's gone up, just because of a technicality that it's a disposal, you're then landed with a potential, if the price has gone up, a capital gains tax bill.
I know what you're saying, and many people will see that because it's the investor's perspective. From a tax perspective, all we're saying is if none of that happened and your Bitcoin went up and you sold it, you would have the same thing would have happened. Now you have to remember, because the next person in the comments will say, but what if I didn't sell it? I wouldn't have crystallized. You are correct, but your base cost would have been the initial 100 grand. And if it went up to say 1 million and you paid taxes on 1 million at that point earlier, the next time you do sell it, your base cost is 1 million. So if you sold it for 1.1, you only paid taxes on the 100,000. Whereas in the initial way, in the initial example where nothing happened with Celsius, you just had that Bitcoin, it went up all the way to 1.1 million and it started at 100,000. At that same moment, you would pay the full £1 million worth of gain tax on the £1 million worth of gain all in one go in the second sort of moment. Whereas with this way, you're paying a lot of it at one point and then even less at the second point, but overall it's exactly the same. So you are right that it doesn't seem fair, but overall it will be fair. Now the problem here is if we change the tax rates by doing it the initial way, which you said doesn't seem fair, it'd be more beneficial than if none of that had happened, because you would have paid taxes for a large amount of that at currently maximum of 20%, whereas with the new anticipated possible increase in capital gains, you might have paid a lot more, maybe 40%. Who knows? So I agree that it doesn't seem fair, but if you think of it as overall, you'll pay the same. You might even pay less if the tax rates go up, but you might pay more if the tax rates go down. It's a very four-dimensional picture, unfortunately. It's extremely mind-boggling at some points.
Yeah, no, it's really complex. I think just from an investor's point of view, it's more the like unrealized versus realized thing. And if it's out of your control, it doesn't seem fair. But yeah, no, I get that definitely. So that ends this video on UK crypto tax regulations, and hopefully that's helped. But do look out for the other videos where I ask Jamie some more questions. It certainly is a bit of a minefield, quite stressful and complex if you've made a lot of transactions over a period of time. So having someone there who's qualified, experienced and knowledgeable in the field can save you a lot of time. And I'd like to thank Jamie for giving up his time again and sharing his expertise here. And if you're interested in getting specific crypto tax advice with Miner, then you can contact them directly using the link in the description to this video, which will take you to an online inquiry form. And you just need to add my name and YouTube channel in the referrer box, just so they know where you've come from, basically. And a great starting point is also Koinly, the automated crypto tax software that I did a video on in my channel also. And there's a link to sign up for a free Koinly account in the description to this video. If you have any other questions about crypto tax, please do add them in the comments to this video, and we'll do our best to answer them in a future video. And if you're interested in more of a tailored approach to your crypto education, and you think you'd benefit from having someone look over your shoulder and guide you on your journey, I do offer one-to-one coaching to those who have the desire and means to educate themselves further. And there are links in the description where you can message me and book in a free video call to see if we'd be a good fit. And if you found this content interesting, please do like the video and subscribe to the channel, as it really does help. And have a great day.